Hello, everyone, and welcome to Think Like a Startup, Onshape's webinar series, where I host.
I think you're live.
And where I host fireside chats on startup thinking with the people who do it best. Oh. These webinars are perfect for both startups and people in companies of any size who want to work like a startup. I'm Jon Hirschtick, EVP and General Manager of Onshape at PTC. I've spent my life building CAD systems, but the best part of my job is meeting the most awesome people in the world of product development. And in this webinar series, you get to meet them too. Now, today we're live with our guest, Axel Bichara. He's co-founder and general partner of Baukunst, a new venture capital firm. He's an experienced entrepreneur and venture capitalist and a great friend of mine for many decades, who also funded SolidWorks, my old company, and Axel was also a co-founder and board member at Onshape. He's invested in many fantastic hardware companies, some that you've heard of and some that you haven't. He may know more about fundraising, particularly in hardware-related businesses, than almost anyone I know. We hope you gain insight on fundraising through today's discussion, whether you run a startup or whether you work for an enterprise, large corporation who strives to be agile like a startup. And be sure to stick around at the end of the session for a 15-minute Q&A. You'll have time to ask Axel questions. He'll answer them live. You can type your questions now or anytime during our discussion. Type them as comments in LinkedIn or your YouTube window. We'll try to get to all of them during Q&A at the end. With that, let's get started. Axel, welcome to the webinar.
Thank you for inviting me.
Well, hey, Axel, tell us about your background. We know that you're at Baukunst, very exciting. We're going to talk a lot about it, but how did you get here?
So I grew up in Berlin, studied mechanical engineering, was pretty good. So went to MIT. That's where I met you, and then co-founded my first company again with Jon. And after we sold it, became a venture capitalist. Joined a firm called Atlas Venture, which was very early in its development at the time. Ended up spending 19 years there. Grew to billions under management. And then left in 2012 to co-found a venture firm called Bolt, and I'm now a co-founder of Baukunst.
Okay, so fantastic. Let's start with what kind of company is a good fit for raising venture capital, Axel? What are the criteria you think?
I think the most important thing to understand is that for the venture capital business model, there need to be billion-dollar plus outcomes for our model to work. So in the end, it's only companies that have the potential to reach billion or many billion-dollar exits in an IPO or in a sale to be suitable for the model. So the vast majority of good companies are actually not suitable for venture, and that's very very important to understand. And when we invest in companies, we need to have a chance to achieve these outcomes within 5 to 10 years. So relatively quickly, you need to scale relatively capital efficiently, and you need to have a founding team and a market opportunity which is fundamentally big enough to have the potential to build such a big company. So there are plenty of other ways to fund and build companies, but my view of life is a venture-backed company lens.
So, if there's a hardware component, then what particular challenges are there?
Yeah.
Because most of our audience are people who build hardware.
Yeah. So in all companies we look at, we focus on high margin recurring revenues. Often it's software, it can be consumables, it can be food. But high margin recurring revenues and an attractive LTV to CAC relationship is extremely important. So the moment hardware is involved, it gets more complicated because there's a higher cost of goods, lower margins, and it needs to be thought through. And so the things to focus on are the high margin recurring revenues, the achieving product market fit quickly and with as little as capital as possible, because it's more complicated to build a hardware company than a hardware product than a pure software product. And then it's also important to have a business model which can scale without burning a whole lot of capital. If you need a lot of working capital to scale, it's dilutive for founders and less desirable, and reduces returns for everybody. So thinking through the business model details of a hardware business is more complicated, but there are also advantages. People are often more willing to spend money up front if there's a hardware component involved. And hardware is also a barrier to entry, because it's harder for the next competitor to duplicate it.
Okay. So when should companies be fundraising?
So I'm a fan of entrepreneurs starting very early. Really, the moment they are committed to actually starting the company, to speak with the highest quality potential investors possible. And you don't necessarily walk in and say, "Oh, I want to raise X amount of dollars." It's relationship building. How do I build this company? How do I raise money? You want to find investors who are super experienced, have a strong track record in your area, in the area that you want to build the company in. And there is really no too early in my experience. And while much of the venture business has moved to later and later stage, there are many people like us who fund companies when entrepreneurs first get started. And so having a conversation early on to start to build the relationship, ask questions, is fundamentally good. You want to do it with a relatively small number of the highest possible people you can get access to, I would say.
Okay. Hey, another question. How many companies have you looked at in your career?
The ratios are, we look at about 250 companies for every one we invest in as a firm. So that translates into several thousand per year, and we multiply that by me having been around for a little bit, so it's tens of thousands of companies. Of course, we don't look at all these companies in depth. Many get, there's a very quick screen, and then you move on. But it adds up. It's certainly tens of thousands.
Okay. So, how do you know if you're going to be a fit for the venture capital model?
Well, if you need to, first of all, have a conviction as an entrepreneur that you can build something big. And if you think, well, I'll pretend I can get to something big, but I'll be really happy with getting to 10, 20 million revenues and sell it for 100 million. Don't speak with venture capitalists. It needs to come from your heart as founder, and from your ambition, and from your belief in the market potential. That's the most important thing. And then now, many founders are are very optimistic, and so often people think, well, this can be really big, and then maybe realistically it won't be that big. But you want to speak to good people early on, good potential investors, and things will fall into place, and you will find your way.
So thanks, Axel. And I want to say I was having an audio issue a moment ago, so yeah. I'm sorry if I was pausing oddly or so. I was getting this terrible echo, and I finally figured out what had happened. Thank you to our staff online there. So that's why I was delayed and looking weird. Anyway, back to Axel. I want ask you, can you tell us about a deal or two that you've seen? Like, I know you have some amazing stories of really entrepreneurs who came to you, what kind of phase, what you saw in them, and what the outcome of the company has been.
Yeah. So I'll talk about a company that's fairly well known right now called Tonal, which is exercise equipment for strength training. The founder, Ali, came to us with a motor with a string attached to it and said, I think I can build an exercise machine which feels like weights with sophisticated motor controls instead of physical weights, and mount it at home and people can exercise from home. And so it was, this was in 2015. The vision was people will want to exercise from home in a connected way, totally plausible. A complicated machine, barrier to entry, recurring revenue business model, but also an amazing story of what we call founder market fit. Ali had lost a lot of weight in going to the gym and said there's got to be a better way than the way he went to the gym. And so it was really, he built the product for himself, and that's often what we look for, this founder market fit, and ideally developing a product or pursuing a vision that would suit themselves maybe in an earlier part of their career. So so we funded this company with a relatively small check, but when it was just Ali when he got started.
And for those who didn't catch that, that's Tonal. This is the company that, Axel, correct me if I'm wrong, is on like television now. Like you watch like a nationally televised football, the Super Bowl or something. There's the commercial for Tonal with LeBron James, or I think it's Serena Williams. I may be demonstrating. So that's quite a journey. And how many years was that from the time he had the motor and the string?
I think we funded it in I want to say 2015, maybe 16. Yeah, there was just Ali and the motor.
So like 3-4 years from Ali and the motor to LeBron James, and big company. Amazing story. And also you were the first money into that company, right?
First and only at the beginning.
Only investor. Wow. Good. Well, good for you, Axel. That's, I assume, one of your many successes. And but you provided more than money to Ali and to your entrepreneurs in general, certainly to me in working with you. Can you elaborate on that? Because some people think venture capital is just about giving the company money, but what else do you give?
Yeah, well, we even picked the name for our new firm to illustrate what we do, or to articulate there's such a thing. It's Baukunst, which is German for the art of building, and we picked it because we believe there is such a thing as the art or craft of building companies, and it's something we have practiced for a very long time, and we think we're pretty good at. So getting things right, especially in the very messy first few years of a company's life, you can make a huge difference by making good decisions about team, about capital efficiency, about establishing product market fit quickly, about focus, about business models, business model trade-offs. And I have a total conviction that's why we called ourselves Baukunst, that it can make a huge difference. And it's actually the way I learned the venture capital business back in the 90s, with very experienced people who had many billion-dollar outcomes joining boards very early on, helping build companies. And that has gotten lost a little bit in the last few years as venture funds get larger and larger and people invest at later and later stage. And the craft of getting things right from the beginning has gotten lost a bit. And that's something we practice with a passion.
That's very well said, Axel. And I think if there's something the audience can take away, it's that the craft of getting things right early in the company, an experienced investor brings that besides the check. And that's certainly the case with Axel. You mentioned how things have changed in fundraising. Can you summarize, how is fundraising, the venture capital scene, how is it different now versus 10 years ago, 15 years ago?
You mean for venture, for entrepreneurs, right?
Yeah, for entrepreneurs in the venture world.
Yeah, you have huge amounts of capital really at all stages, where the big brand name venture firms have mostly moved to later stage, what was called gross equity maybe 10, 15 years ago. At the early stage, there's a lot of angel money, and there are many small venture funds, and there are larger venture funds making small investments to kind of get a foot in the door for follow-on investments later. But there's surprisingly few investors who go in with conviction, lead around, take a board seat, write a large enough check to solve a founder's funding problem. And so the irony is, with all the with a lot of money that's available, it's a more noisy environment. There are relatively few people who really practice this craft of putting serious time into the companies besides the money.
Yeah, so there's fewer people like you.
Yeah, fewer people like us, but more people many more people in general in investing.
Yeah, so more money, but less people in your end because the bigger fund moves downstream. Yeah. Speaking of big funds, I mean, or small funds or whatever, how should someone think about how much money they should be trying to raise?
From an operational standpoint, you typically want to raise money for about the next 24 months, which means you have runway of about 15 months, and then you need to raise your next round. And you never want to be in a situation where you raise money when you're out of money. And that's where this, this just thinking through the runway is very important.
Okay.
So 24 months is a good rule. In earlier stages, when people first get started, often people raise less, and because it's relatively easy to add additional money if necessary. But this rule of 24, maybe 18 months is a good one.
And that assumes you can get it. Sometimes people take what they can get, even if it's less, right?
Oh, yes, correct.
Yeah,
correct. Well, and you also need to optimize for dilution, right? It's not just how much to raise, but it's what amount optimizes dilution versus runway to build the company versus risk you're taking.
If you're not sure you're a fit for venture capital for the model, how would you find out? Like, someone listening may say, I'm not sure this is a fit for me. What should they do?
They should first ask themselves, do I have the interest and ambition to build something really big, work around the clock for 10 or 20 years? And if the answer to that is yes, speak to a few people like me and see if it resonates.
Yeah, and we're going to have you, by the way, we'll mention it at the end, but you can actually reach out to Axel, right? At website is Baukunst.co. We'll probably flash the link here. And his email is axel@baukunst.co. So you can actually reach out, right? Axel, so you're saying just jump in and meet rather than worry forever and do too much thinking. And I think you mentioned to me that, as people would imagine, a so-called warm intro is better than just showing up at the website, right? How would people get that?
If people who look for entrepreneurs they want to fund are not that hard to find. So I think it's the first test. Can you find my email? And or can you find somebody who knows me and get an intro? I should probably add to the intro, you don't want to just say, "Oh, I'm Joe, I'm cool. Can we talk?" Right? There needs to be a high-level description of the area. What business are you fundamentally in? Why are you a relevant founder for that? I mean, some basics need to be there, but it needs to be highly interesting somehow, and this founder market fit needs to be there. And then with very little information, we're happy to have an initial conversation.
You are. So you're happy to have a conversation. Yeah, that's great. That's great. And how long on average do you know somebody before you invest in them? Is there such a thing?
Probably an average, but there's a very wide distribution, obviously, from people you've backed before. But to companies where you meet the founder or founders and you get there from a first meeting within a few weeks. I mean, it totally happens, especially if it's markets we're already familiar with. We may have looked at other companies in the area. And if the closer people are to our existing ecosystems, the easier they are to reference check. So even if we don't know the founders, if they're easy to check out, that also accelerates the process. But we have an interest in moving quickly, right? We have no interest in being slow investors. So every deal we look at, we move as quickly as we can within the time we have available, but then also the information we receive.
Sure.
And so,
yeah, and also people. So what you're saying is, if I may not know a venture capitalist or know you beyond your name in the webcast, but the webinar, but I may know somebody who I know raised venture capital as an entrepreneur, and they could be a reference in, right? Or a friend of a friend. Everyone knows how to use LinkedIn and so forth. You're saying just get out there. How many venture capitalists should people meet with? Like, should they go to one, call you, or 2 or 3 or more?
No, our recommendation is generally a small number of well-targeted ones. So maybe a handful ideally. And but the targeting is very important. And especially in the last few years, people are broadcasting to everybody who has an email address in some cases. Carefully thought through, researched relationships. You're building a relationship with an investor. It's not a transaction, it's a relationship to get a successful investment done. And they need to have relevant experience at your stage in your market, and you also want people to have a track record. How many billion-dollar outcomes have they had in a given space?
How many billion-dollar?
And then I would say a handful, have some conversations and see. And you may not get it totally right the first few conversations. And then if you may be interested, if you just aren't right, and then you add a few. But talking to 10 plus people in parallel tends to be counterproductive.
Yeah. So what about, I think you mentioned quickly angels earlier. So what about angel investors? There's a lot of angel investors out there and stories about it.
There's a huge amount of angel capital with a very wide range of sophistication some angel investors who are some maybe former venture capitalists who are almost as good as an experienced VC to people who really provide the capital and not a whole lot more. And my recommendation is always, you are only as good as a team you play on. Get the best possible investors, just like you're hiring the best possible team. And that includes angels as well. So they're very, very high quality angels. Focus on that if you can. And also watch for sort of investor company fit. You want ideally a smaller number of investors who are happy to be investors in terms of ownership, in terms of being able to add value, etc. But if you just look at it as a transaction, I want to raise as much money at the highest possible price, you're compromising this potential relationship from the beginning. The goal needs to be surround yourself with the best possible people to build a great company.
By the way, you mentioned price. Let's jump to that topic. Yeah. So somebody meets a couple of venture investors, maybe there's interest. The subject of valuation comes up, and how should somebody, especially someone who's never raised venture capital, how should they think about the valuation, meaning how much the company is worth?
Yeah. So the thing to think about is valuation is one of the parameters, but we generally say focus on dilution, not value, not just valuation, because in the end, what matters is in a given fund, in a given round, is how much equity do you give up and how much runway do you get, and the dilution is really capital, amount of capital multiplied by the dilution is determined by valuation and amount of capital to raise.
Yeah.
So the less you raise, the better. That's one of the simplest tricks, right?
Yeah.
If you can get away with raising less money, especially early on, it's less dilutive. You retain more ownership. The investor, for the same amount, there's less pressure on the investor so if there's less dilution, it's also easier for the investor to get a deal done that works for their business model. And coming back to this craft of company building, I've used the words capital efficiency a few times before. By being more capital efficient, it's better for everybody because we can raise less dilution and actually a more attractive deal for the right investor. And there's a little bit of a culture out there is the more you raise, the better it is. But I'm totally a non-believer in that, especially early on. Yeah. Every dollar you raise, you need to return. It's liquidation preference sitting in front of the founders. And the less you get away with, the better, generally speaking, assuming you can reach your operating goals with some buffer.
Now, you mentioned that phrase, liquidation preference. Some in our audience may not know what that means. Could you give a quick explanation about that as one of many terms that come into these?
So all venture deals get done for what's called preferred stock. And if the company doesn't do so well, the investor has the option to either receive their money back that they invested or convert to the common stock, which is what the founders have, and then participate in that. So if you raise 10 million and sell the company for 12, the first 10 goes to the investors and the rest is split with the common. So the more money you raise, the more sitting in liquidation preference in front of you.
That is a very common term in the venture capital community and an important one, for one of many important terms. In fact, we could do a whole nother webinar on the terms of venture capital investments, which we're not going to do here. Angel is one alternative. What about how much of our discussion applies to people who are not starting a company, but who are in a bigger company and trying to fund an internal project, an intrapreneur, so to speak, which we see that a lot. I myself, in a sense, I work for a pretty big company now.
Yeah. So what I found is that the rules or the advice for success that I would give is it's almost the same thing. It's very, very similar. You need a great team to start with. You need a market opportunity. You want to achieve product market fit and business model proof on as little capital as possible. This all applies in a large company. You probably have the additional difficulty in a large company. Can you get a fully dedicated team? Can you get the right, those big financial incentives? Can you get that right? That may be a little more tricky. But the basics of business model, of business building are the same fundamentally.
Mm-hmm. Okay, so this can apply because we're all, people who build new products, our audience, product developers, are often advocating selling their design. Maybe not as a new business, but they're saying we should build this product or even this feature, right? I know I can relate to that from talking to product developers. So it's interesting to think about making those cases. You are not just an investor, but as we touched on, I think your background, you're a founder and entrepreneur yourself, both working with me in building 3 companies, 2 of which you were co-founder of, I think. Yeah. And how much has that helped you in your career as an investor?
I think having been on the founder side has been hugely helpful. And whether it's the interaction with understanding what it feels like, the interactions with potential investors, the pressure of you raise money and now you need to sell product, find customers, build a team. Typically, what can go wrong will go wrong, and having seen that journey, and for what it's worth, in the venture capital business, we're entrepreneurs too. We raise money, we build a company. Not everything goes well, and it's we're really not that different from the business model is a little different, but we're not that different in the fundamentals of the business in the firms we build.
Well, and that's it's a fresh subject for you, right? Because you're just starting. You're open for business now, right, at Baukunst, but it's a startup, right?
Yep. It's I've worked with I've had the privilege of working with my my co-founders for a good number of years, but it's a fresh new firm, fresh new investor base, and an exciting journey.
By the way, some people out there may know that I was the lead founder of SolidWorks and CEO for many years, and Axel was the first venture capitalist to commit to investing in SolidWorks. So since the first money into SolidWorks, I want you to know, people out there should know that it's possible there wouldn't be a SolidWorks without Axel, because Axel really supported me when nobody else would. I got turned down for investment at least, I'm going to say 10 different venture capital firms turned down investing in SolidWorks. Axel was working at Atlas Venture at the time, and Axel stuck with me and believed in the idea and helped me build it with some critical people that he introduced and support. And so thank you, Axel, for me, certainly, and for many in the audience might be SolidWorks.
Well, and saying people. I wouldn't be here without you either, Jon.
Well, it's nice of you to say. And
I'd like to add something on engineering software, right?
Yeah.
We with Onshape, it was obvious, as Jon knows to me, long before Onshape was started, that there needed to be a cloud-based CAD system. And that's architected right. But it's true for really everything in engineering and manufacturing software. Whatever hasn't moved to the cloud yet will move to the cloud. You go 10, 20 years into the future, engineering, manufacturing software will be in the cloud. And there's actually still a significant opportunity out there. And these are investments we're actively making.
Yeah, well, that's... and you in engineering software, besides SolidWorks and Onshape, you're in a couple other companies that our audience might be interested in. Will you touch on those?
Sure. There's one company which is fairly well known already called Vention, Vention.io. They make factory automation solutions where you start with you go to a web browser, design basically a machine with some controls, automation, controlling robots, etc., and can basically place you build the machine out of predetermined components like Lego blocks, and then when you're done, you hit order, the machine ships to you, and you assemble it like an IKEA shelf. So it's a consumer-like experience almost for heavy-duty factory automation solutions in a very that's very approachable and very easy to get started with. So we were the first investor there when the founder Etienne first got started. I remember Jon helping me with the due diligence at the time.
Yeah.
And the company is doing well. We're very proud to be investors there.
Well, congratulations. And they are nice people and a really interesting company. I think would appeal to many in the audience, may be interested in being Vention customers. I think that it's maybe time to turn to some questions. I see one of the questions says, thank you for SolidWorks, and happy that I know we have Onshape fans out there, SolidWorks fans. We may have some Vention fans out there too. Axel, a question here. What is the distribution of returns from companies you invest in? Like X% generate Y% returns.
So it's a question
good question.
I really like. Yeah. So the interesting answer is probably that it doesn't matter for our business. What matters for our business is that the big outcomes are really big. And so if you actually do a spreadsheet and you do you have the variables of percentage of success percentage of times you make, 1 time your money, you lose money, you make 5, 10 times. The parameter that matters the most is that the big outcomes are really big. And so that drives our investment strategy. We look at every investment as a shot on goal to return the whole fund. And that's where the $1 billion outcome comes from. And if you achieve that a few times in a fund, you have excellent returns. And you can, in theory, have a 75% failure rate as long as you have a few big successes. That's really talking about our business. In practice, we in the last few funds, we have made money on probably 2/3 of the investments we've made, and this is from investing very early on.
Wow.
Some of them are not done yet, but if you invest very early on, you put a lot of time on it. The time you may make 2 times your money, that's a failure because you put a lot of time into it, not a large check. So we need to think much bigger. But the failure rates are actually surprisingly low.
That's really interesting. 2/3 you make money. So you're swinging for the fences. You're home run like modern American baseball. Home
absolutely.
run driven activity, which is why I said I like that phrase, shot on goal. Of course, a sports analogy, so to speak, a shot that could be in the $1 billion goal net. Another question here is, what is your due diligence process when considering? You might explain what a due diligence is, a familiar term to us, but maybe to viewers.
Yeah, due diligence is a process we go through to figure out whether or not we should invest. And the way I think it's important to explain. We're 4 partners. We do everything ourselves. We're in the business of doing deals. We want to get things done as quickly and as efficiently as possible. It's just important to for entrepreneurs to put themselves into our shoes. So there's actually no predetermined process. You work on whatever the biggest concerns are. So it often starts with a founding team. How good is the team? Strengths and weaknesses, etc. So team is number 1, and this founder market fit I mentioned earlier. Market size, market potential, competitive landscape, and then also operating plan. How can you operate in the next 12 to 24 months to build value and specifically product market fit and beginnings of business model proof. And so we work on that as quickly as possible. And sometimes it goes well. We know a market and it's a week or 2. And sometimes you find stumbling blocks. Oh, what's going on here? And then it takes longer. But it's not a predetermined process.
And you do that work yourselves. So
we do everything ourselves. Yeah.
You don't hire somebody to say, like a investigator, give me a report on this.
I mean, we reach out to people, like I said earlier, in Vention, reach out to people like yourself, Jon, to help check it out. But things like reference checks, I cannot be delegated, right? We need to make the judgment call. Is this a founder we want to potentially be investors with for the next 10 to 15 years? And I think delegating that is just not right. I need to develop that conviction myself for deal meeting.
That makes sense. That makes a lot of sense, and that may be interesting even to the audience to hear. That they're if they're gonna meet and hear your story. But there's another question here. A great topic. I'm glad they brought up here is how do founders tell a compelling story to investors? What advice do you have on that?
The biggest piece of advice is be yourself, right? Because you can't you can't fake it really if you're not made to be the entrepreneur you want to be, or even if you raise the money, well, eventually it will not work if it's not meant to be. So be yourself. Why are you doing it? What do you believe in? How are you building your team? Where do you want to be 10 years from now? What are your motivations? And so it's not pretty, a pretty slide deck and I'm really cool. I've been very successful. It's why am I doing this? Be yourself.
Why am I doing it? Yeah.
We're trying to get into founders' heads to understand why they're doing it, and because it's such an all-consuming journey. It's a wonderful journey to build something, but it's also crazy hard work.
Yeah, actually, great topic, and it reminds me that back when you invested in SolidWorks, you were a venture capital, you were on my board and everything at SolidWorks. You invited me to an event with a coach, Jerry Weissman.
Oh yeah, Jerry Weissman. Yeah.
Yeah, and he gave us a talk on how to tell story, and it was an incredible talk. It changed how I think about it. For really, the summary I would say is it taught us to frame a compelling story, a short storyline to start a presentation with about what you're really trying to accomplish. I personally like it when entrepreneurs are focused on their mission and not trying to come in and be a financial person to negotiate with you. Like if you start to talk by asking for money, that's probably not the, but entrepreneurs who are on a journey to change the world. In fact, I have a book on, I came across recently. I met a guy named David Reamer who wrote a book. I have no connection with David Reamer, by the way. I just am mentioning Get Your Startup Story Straight. It's a book that Axel, I will say, and I'm going to ask if Alexis maybe you'll post the link. It captures the essence of what Jerry Weissman taught us years ago in that session that you hosted. But that is great. Another question, what are the common mistakes? Are there certain things you see people do that you and your partners roll your eyes and go, oh no, it was that problem again?
That's a potentially very long list, but I think I have a few, so I'll make a few comments. One is, remember that you're building a relationship with somebody who helps you build your company. It's not a transaction to raise money. Technically you can't fire your investors, but depending on the deal structure, your investors may be able to fire you. So be focused on the relationship building. Be totally transparent. Obviously well prepared and thoughtful, but not nobody can know everything. Big is not beautiful. I think raising more money, being better, as I said earlier, I'm not a fan of that. The investors are likely to figure out what's really going on, so don't underestimate the level of experience and sophistication. And also look for investor fit. Is this really the right investor to help you build this? And does it work for the investor's business model, right? If you're looking for a $100 million outcome, well, there's certain investors you can speak with, but you shouldn't speak with with investors like us.
Yeah, I think that is one of the key takeaways today is the fit. But you've given so many great tips. Let's see if there are any other. I see some questions that we've already answered, and I think you've covered through your comments already. I would like to also say that the way you help companies, and you talked about it being unique. Where can people go if they don't raise money from someone like you? How can they get some of the help you'd provide? I know I'm not trying to say to compete with you, but not everyone's going to be a fit with venture capital, but they still need help. Where should they go to get help in the craft of building their
money
company?
Comparatively easy. The experience is, I would say, the scarce resource. And if it's not a fit for venture, I think angel money, basically private individuals' money, is most often the source. But think about or try to find a few investors who have really good experience, who can really good advice. Now the problem is everybody loves giving advice, but not every advice is that great. And so sorting through that is complicated as a founder, and that's where this question of build the best possible team you can, and you're only as good as a team you're playing on. I mean, these rules I always come back to. And it totally applies to investors. But also sometimes you raise money from individuals, and there's a lot of advice. If you realize it's a wrong advice, you've got to, you're not, it's not a popular, building a company is not a popularity contest with investors.
Yeah.
It is building a great company, and often it may go against the advice of some investors. And just be realistic about what you're getting. And maybe all it is capital, and that's good, but then find your own path that makes sense to you as a founder.
Well, Axel, I think it's time flew by, but I think we're going to wrap up and say, first of all, a huge thank you for joining us today, Axel. I know you're busy. I know this is time you could have been meeting new companies, doing due diligence. You took the time to be here with our audience, and I sure appreciate it. I really hope that this has been valuable to our audience today, whether you're thinking of beginning a startup and wondering how to raise money, whether you're in a startup and working on raising money, or whether you're in a bigger company or another institution and you're trying to essentially fundraise for a new idea that you're starting within an organization. I hope that you got a dose of how to think like a startup about fundraising. And Axel is the greatest person to hear from on it. You can reach out to Axel now that he's open for business and looking for deals in the hardware and software space. You entrepreneurs, reach out again. Axel's email is axel@baukunst.co. It's flashing on the screen now. And you can check out more about Baukunst. Very cool website at baukunst.co, the website. Please, we want you to stay engaged with Onshape by subscribing to our LinkedIn and YouTube channels. You can reach me on Twitter at jhirschtick, JHIRSCHTICK. And keep an eye out for the next episode in our Think Like a Startup webinar series. See you next time.
Thank you, John.